Hello, this is Angus Murray from Castlestone Management. I just wanted to present to you 11 slides with regard to our update on the markets. Obviously, markets have had a very good performance throughout July and the latter part of August, although in the last week or so there has been more of a risk-off series of trades. It does, however, conclude that the market is likely to have bottomed back in June of 2022. We've entitled this presentation that the FOMC is likely to slow the increase in the rate that it is increasing interest rates, because it certainly looks like the FOMC has got control of the narrative with regard to inflation, even if we haven't seen inflation numbers drop as much as we would perhaps hope. The other point to highlight is that equity markets tend to have a positive performance just after a US recession has actually occurred. And that is certainly where we are at this point in time. In other words, they have a worse performance before that recession, and then they have a better performance after people understand that it is now at the bottom or beginning to pass. Three main points we'd highlight is the Federal Reserve is clearly taking control of the inflation narrative, which means markets have a degree of comfort with regard to the inflation outlook. The second point is, as we highlighted in a couple of slides, that although recovery times and strengths vary, equities tend to have a positive performance once a recession has started. And then lastly, reiterating that point that equity performance is the worst 1 year before a recession, but certainly when you look out over 6 months, 12 months, 24 months, and 3 years, equity markets tend to have positive performance. This chart was just highlighting the fact of the outlook with regard to interest rates as they stand at the moment. You can see there by the end of the first quarter of next year, 2023, that it is likely the Federal Reserve will be cutting interest rates. Also, when we look ahead, the Federal Reserve is clearly only just beginning the process, although the markets have already adjusted to it, that it is unwinding the balance sheet or the increase in the size of its overall balance sheet. You have to think that a return to normal and a shrinking balance sheet is overall positive for the economy, at least in the United States. I imagine the Federal Reserve will slowly taper off its balance sheet. It won't do anything drastic. When we take a look at inflation expectations and equity markets' reaction to it, clearly the drop in crude oil prices has had a long-term effect on the outlook with regard to inflation. That is that the 5-year forward on inflation, having once been above 3.5%, is now coming down much closer to the Federal Reserve's target of around 2 to 2.5%. That the core level of inflation did in fact cool moderately in July, and although it will take a time for that to continue to cool, there are clearly indications with regard to commodity prices that we will see lower inflation, or perhaps have already seen a peak in annualized inflation. And the markets have taken that positively, although bouncy at the moment. Ultimately, as inflation comes under control, expectations of cut in interest rates will come through, as we previously showed you, which will then lead to the Federal Reserve cutting rates and the market beginning to factor in a recovering economy. How long will it be before inflation comes down to the Federal Reserve's target of 2%? As indicated, probably a while. And you can see here that the average investor is looking at that around a 2-year period. But once we know that it's peaked and we are in a slow decline, to come back down to that 2% level is the point when markets react. And they have begun partly to react positively to that, but they will probably continue to do so. When we take a look at that rebound the market has had, you can see that in July and August, a bit more bumpy now. Will probably continue to be bumpy, but I think the trend line is we have seen the worst of the equity market performance and perhaps have already seen the bottom in the month of July 2022. There is room for a bounce. A bounce may also mean more of a slow but steady upswing in equities. And you can see that from the number of asset managers who still have a very negative outlook. Obviously, investors have to turn to a positive outlook, start putting money in, stop taking money out to get a better performance in equity markets. But it is unlikely to get much worse from where we are at the moment. And then these slides which I've shown you before, what is the outlook with regard to equities once the S&P 500 has fallen 20% from a high, with data going back to 1950. You can see that the 1 year average is 15%, which is about where we are at the moment, 2 years 26%, and 3 years 29%. And then reiterating the same numbers again on this last slide, just taking a look at what happens when you have growth scares or bear markets. You can see the major downturns that we saw there. We obviously saw equities being the S&P 500 down over 20% and NASDAQ down more. But what normally happens after that, and you can see there in the yellow what the next 12 months looks like. If you'd like any further information on that, by all means, please contact our salespeople and we'd be happy to help where possible. Thank you.